Okay, let's get started. Welcome, everyone. Thank you so much for joining Investing Your Retirement Plan in a Climate Safe Future. My name is Cassie Kane, and I will be hosting tonight's webinar. I'm a climate finance campaigner with Stand.earth and help coordinate climate safe retirement funds. Before we get started, I want to cover some brief tech logistics. First of all, just wanted to let you all know that this webinar is being recorded, so you all and anyone else who registers will receive a link to the recording later in a follow-up email. If you have any questions, please write them in the Q&A box, and one of our panelists will answer your questions there. We're not going to take time for Q&A after the presenters, so just make sure you ask your questions using that Q&A function. If you have any tech questions tonight, the amazing Amy Gray is here and will be providing tech support, and will also be able to help you. So feel free to send Amy a message. And also in the follow-up email, we will be sending out the slides that are shared today and any other relevant links. So if you don't, we'll be sharing the links in the chat, but if you miss them, don't worry, you'll get them in the follow-up email as well. So with that, let's get started. Next slide, please. Thanks, Amy. So first of all, you may be wondering why we're focusing on retirement funds today. The answer is because there's over $40 trillion in US retirement assets. And the vast majority of us are unknowingly invested in fossil fuel companies through our retirement plans. So this means our retirement savings are enabling fossil fuel companies to continue to produce and burn more fossil fuels and drive up global greenhouse gas emissions at the very time when we need to be doing the exact opposite, urgently and rapidly decreasing emissions. By choosing a climate safe option for your retirement, you could join a movement that can get close to $1 trillion out of fossil fuels, making this one of the biggest ways you can take climate action in your personal life and also make an impact on a systemic issue within your sphere of influence. Next slide, please. And yeah, to make matters worse, fossil fuel investments are underperforming and exposed to financial risks. According to the Institute for Energy Economics and Financial Analysis, the fossil fuel sector has underperformed the S&P 500 in 7 of the last 10 years, delivering the lowest performance and highest volatility of any S&P sector. The good news, though, employees have the most influence over our retirement plans. This is an opportunity to regain control over our retirement savings, ensure that those savings are safe from climate-related financial risks, and to retire with dignity, knowing we are helping future generations inherit a better world with our retirement investment choices. Many employees have already shifted their savings out of fossil fuels, and workers with pensions, including workers in the SAG-AFTRA union, are pushing their pension funds to get out of fossil fuels too. Today, we'll help you access the tools to join this powerful movement. Next slide, please. On this webinar today, you'll hear from 3 experts on different aspects of climate safe investing and how to make your retirement funds climate safe. So first, we'll hear from Grant Bradsky. Grant is the Sustainable Investing Initiative Senior Coordinator at As You Sow, the nation's leading shareholder representative with a 30-year track record promoting environmental and social corporate responsibility and advancing values-aligned investing. Grant works at As You Sow's Invest Your Values program, which creates free online tools that analyze the climate and social impact of thousands of US mutual funds, ETFs, and 401k plans. Prior to joining As You Sow, Grant worked as a grassroots environmental advocate on campaigns to strengthen protections of our nation's air and water. He holds a BA in business with a focus in entrepreneurship and management from California State University, Chico. Grant lives on Miwok land in Petaluma, California. The next panelist will be Kathy Becker. Kathy is the Responsible Finance Campaign Director at Green America, where she creates tools and educational materials that help people use their banking, credit cards, property insurance, and investing to build a more sustainable and equitable world. Based in Central Ohio, Kathy is also the board president for Save Ohio Parks, a nonprofit that works to protect Ohio's state parks, wildlife areas, and public lands from oil and gas extraction. Previously, she directed the sustainability nonprofit Simply Living and chaired the Ready for 100 Columbus campaign, working with the city to create the largest 100% renewable electricity aggregation program in the Midwest. She lives in a Columbus suburb with her husband and 2 cats. And our third panelist today will be Alex Wright Gladstein. Alex is the founder and CEO of Sphere and an entrepreneur with a passion for addressing climate change. Prior to founding Sphere, she co-founded and was the founding CEO of IR Labs, which makes data centers and supercomputers faster and more energy efficient by using light to move data between chips. She has also been the Energy Entrepreneurship Practice Leader at MIT, and an Energy Efficiency Program Manager and Energy Market Specialist at a smart grid company. She received an MBA from MIT and a BA in Political Science and Economics from Tufts University. Next slide, please. So we have a bunch of amazing panelists tonight. It's really exciting. And this is the agenda for today. We will hear about As You Sow's helpful resources and tools like fossil-free funds from Grant. Next, we'll hear about Green America's Plan for a Better Future Guide for Employees from Kathy. And then Sphere's fossil-free alternative will be shared from Alex, and then I will go over some next steps. So with that, I'll pass it over to Grant now to cover As You Sow's resources. Over to you, Grant.
Right. Hello, everyone. My name is Grant Bradsky, and I am from As You Sow. It's really great to be here today. I think we have a great panel and really looking forward to our discussion. Um, so I thought I'd start today by just giving a quick introduction to our organization and then spend a little time talking about our sustainable investing program, Invest Your Values. And then I'll end by showing you all how you can use our free online tools to not only find out your exposure to unsustainable investments, but also how you can find funds that better support a climate safe retirement. So, As You Sow was founded in 1992 and has become the nation's leading shareholder advocate nonprofit in the US. So, we work directly with corporations to help them assess and mitigate material risk while also becoming more environmentally and socially responsible. So as you can see here, we work with some of the largest companies in the world, and we also work across many different sectors. That is because we have 8 different programs at As You Sow. So we have climate and energy, environmental health, social justice, circular economy, biodiversity, and of course our sustainable investing program called Invest Your Values. Um, so I thought I'd start by just sharing a little bit about how our program got started. I think it's interesting context to kind of share a little bit about our own climate safe investing journey. So around 2010, there were divestment movements happening on college campuses across the US. And at the same time, we were engaging corporations on climate-related financial risk of investing in fossil fuels. So we developed some educational materials to help folks in the movement kind of frame these issues to their universities. It was around the same time that we realized that we didn't actually know what was inside of our own 401k plan at As You Sow. Um, so we did some digging and we eventually found out that we were invested in a way that was not aligned with our organizational values. We were engaging corporations to, ask them, help them become part of the net zero transition, while at the same time we were investing in coal, oil, and gas companies. So we realized, if we had no idea what was inside of our own 401k plan, then likely many others were in the same boat. So we launched fossil free funds back in 2015. And folks can go on to fossil free funds. I'll give you a tour on how to use the tool shortly. But basically, you can find out your exposure to fossil fuel companies, but also find funds that are fossil free. Fast forward to 2025, we have since launched 8 investor values websites ranging from environmental issues like deforestation to social issues like gender equality funds, prison free funds, military weapon free funds, tobacco free funds. And then our newest website is the Retirement Plan Scorecard, where we aggregate all of our mutual fund data and rate corporate retirement plans based on their exposure to our 7 different issue areas. Something that's also really exciting happening at the end of this month is we are releasing our newest tool called Social Justice Funds. And so on October 30th, you'll be able to find out your mutual fund exposure to companies and their grades on gender equality, racial justice, workplace diversity, and LGBTQ plus equity. So really excited about that release on October 30th. I'll drop a link in the chat to our webinar. Hope to see you there. And then finally, something that is really exciting happening over the past couple of years at As You Sow is we developed a new proxy voting service called As You Vote. So if you own even one share of a company, you are a part owner of that company and you get to decide how that company is managed. So you can elect the board of directors, decide on CEO pay, and vote for different environmental and social shareholder resolutions, like the resolutions that As You Sow files. Um, the problem is, yeah, a lot of people don't vote. They abdicate their power by not voting. There can be, many different reasons for this, but it can be a, somewhat complex platform to the average investor. If you own hundreds of stocks, you can, be inundated by ballots in your inbox. So we developed As You Vote. It's a proxy voting service for institutional investors that is really easy to use. It's totally customizable, and your ballots will be cast progressively in perpetuity. And then My Money, My Vote is basically the same proxy voting service, but for individuals. And it is completely free for individuals. You can begin casting your values in one click for free. So definitely recommend checking out My Money, My Vote. So I've talked a lot about values, but obviously saving for retirement is first and foremost about returns. In fact, plan fiduciaries, those folks that are responsible for managing retirement plans, are legally obligated to focus only on pecuniary factors, so just meaning financial factors. So part of our job is to kind of dispel some of the common myths of sustainable investing. A lot of folks think that you have to sacrifice returns to invest sustainably, but that's just no longer the case. As you can see, this Morgan Stanley study of 11,000 mutual funds demonstrates there is no financial trade-off in the returns of sustainable funds and traditional funds. In fact, sustainable funds can often be less risky. That is because the fossil fuel energy sector has been the worst performing sector of the economy over the past decade plus. So high carbon companies are exposing you to climate-related financial risk. You can see, across timelines, fossil fuel returns have been the worst of any sector in the US economy. So this chart is from Sphere, from Alex's team, and basically shows, what $10,000 would be worth across different timelines. And you can see invested in fossil fuels gives you by far the worst returns across the economy. So what does this mean for retirement investors? So last year we worked with the University of Waterloo to quantify the risk of investing in fossil fuels. So we looked at the 401k returns of 12 tech companies had their retirement plans not been invested in fossil fuels over the past decade. And essentially, what we found is these 2 million employees from these 12 companies would have made $5 billion more in returns had their companies moved to decarbonize their retirement plan 10 years ago. And this is because what we just spoke about, the writing is on the wall. The markets have spoken. Fossil fuels are a risky bet. In fact, some studies have shown that, investing in fossil fuels, half of the world's fossil fuel assets could become worthless as soon as 2036 in the net zero transition. So, what are companies doing to mitigate this risk? Well, just last year, Google found that one of their traditional funds was underperforming the broader market. So they searched for a replacement fund, and they actually found that a sustainable fund was the best alternative, strictly from a returns perspective. Um, so since adding this new sustainable fund, Googlers have allocated over $700 million dollars into this fund. And by doing this, they've redirected $63 million dollars away from fossil fuel investments. Um, they've also lowered their financed emissions by 70%. And so thought this was really exciting. And we ran an analysis on our retirement plan scorecard. And we found that the employees from the 76 plans on our scorecard have also redirected $200 million dollars away from fossil fuels by investing in their plan's sustainable option. And because we rated about 10% of the DC market or defined contribution market, so 403(b) and 401k plans, it's estimated that across the US, employees are redirecting over $2 billion dollars away from fossil fuel, so coal, oil, and gas. Just shows that climate safe investing is possible. It's already happening across the US and it will continue to increase. Now, finally, kind of our bread and butter at As You Sow is corporate engagement. So these past few years, we've been engaging corporations, asking them how they are protecting employees from climate-related financial risk generated from their retirement plan investments. Particularly, how are they protecting their younger employees who will spend, the next 30 years in the market exposed to these risks? We always say that, retirement investing is not about the next quarter, but about the next quarter century. And so, climate-related financial risk are increasing with time. The longer you spend in the market, the larger the risk is to your retirement investments. So how can we invest in a climate-safe retirement? So I'm going to just give you a quick tour of our free online investing tools. So if you head over to fossilfreefunds.org, you can type in the name of your fund in the search bar. You can also search by ticker or the asset manager, and you'll be brought to the scorecard of your fund. So on the left side of the page, you can see that this fund earns a D because it has almost 8% exposure to fossil fuels. This is the Vanguard Institutional Index. It's one of the more commonly held funds in retirement plans in the US. You can also see the total dollar amount invested in fossil fuels below the fund grade. And then in terms of the companies inside of this fund, it's all listed on the right side of the page. You can see exactly which coal companies are inside of your fund, oil and gas companies, and then, yeah, a lot of folks are surprised to find out they're invested in fossil-fired utilities. You can also see the entire company list here, the holdings. And then if you scroll down a little bit, you'll be brought to your sustainability report card of your fund. So this is where we list all of the fund grades across issue areas. So if you click on deforestation-free funds, you'll be brought to, deforestation-free funds and your fund grade based on its exposure to agribusinesses involved in deforestation, as well as banks and lenders and major consumer brands. I'm just going to go back to fossil-free funds. So say you found out your fund grades and you want to find funds that are not exposed to different issue areas. You can use the search settings button here, and you can sort for funds based on your personal search criteria. So say you want only positive 10-year returns. You also don't want to be invested in fossil fuels. And let's say you don't want to be invested in deforestation risk agribusinesses. You can see that these funds are then auto-populated at the bottom of the screen. And you can also see how these funds rate across different investment timelines, as well as their grades across our issue areas. And then finally, you can compare some of these funds side by side, kind of the share class overview, as well as their fund grades across the issue areas, as well as returns. And then final thing I'm going to talk about today is just our retirement plan scorecard. So you can see kind of your fund grades across issue areas if you work at one of the companies listed here. So Amazon, this is the Amazon scorecard. You can see the fund grades across our issue areas. We also show employees, the total dollar amount invested in, say fossil fuels. Amazon employees have $1.5 billion in fossil fuels, as well as if employees have access to sustainable options in the plan. It looks like Amazon employees have one sustainable option in the plan. And then we also have an action center for employees. It's kind of a step-by-step process on how you can find out your exposure to these different issues, and then also how you can kind of motivate change within your company. So I know I packed a lot in a short amount of time, but I'm definitely available for any questions. I think at this time, I'm going to pass it off to Kathy from Green America, who's going to share a little bit more about some educational materials for everyone. So thank you very much.
Great, thank you so much, Grant. I'm also going to share my screen. Let's see if we can do this. Okay. Okay, are we seeing a full PowerPoint there? Looks like the correct PowerPoint is showing. So again, yes, my name's Kathy Becker. I'm the Responsible Finance Campaign Director at Green America. And next slide. So Green America has been around. We were founded in 1982, so we've been around for a while. The mission is to harness economic power, the strength of consumers, investors, and businesses to help build a more socially and environmentally just and sustainable society. So in the campaigns department where I work, we focus on consumer education and mobilization. And kind of the theory of change is change happens from the bottom up. And regular people like us are the pressure point for economics change. So we often think of our power as an activist, as a voter to make change in society, but we don't often think about the power of our personal finances, things like our bank accounts, credit cards, property insurance, and our investing. But that can be used to make a difference. And Grant just talked about a big difference that Google employees made just by adding that one fund. Millions of dollars moved out of fossil fuels. And so this really can work. So the first question, and this may be a beginner level for some people on here, but I figure we'll just level set at the beginning. The first question is, why participate in your employer's retirement plan in the first place? And if you're lucky enough to have an employer that has a retirement plan, most of them match at least some of your contributions, and that's free money. So if you aren't contributing, you're missing out on free money. The second reason is compound interest. So if you're putting away, say, even $25 a month, you earn interest on that $25. But with compound interest, that interest gets mixed back into the principal, and the interest earns interest, and that compounds over time. So the difference between just putting away $25 a month for 30 years versus putting it in an investment that earns compound interest is you could have $57,000 at the end of 30 years just from contributing that much. But we want our plans to be climate safe. As Grant mentioned, retirement is a long-term investment, 20, 30 years. And we want the climate to be still livable when we retire at that time in the future. But unfortunately, most employers offer few to no climate safe options. And so Green America has a handbook called Plan for a Better Future, and we literally just updated it. I put the new one on about an hour ago. It was a long process of updating it for 2025. But it's about how to get more socially and environmentally responsible options into your workplace retirement plan. And we wrote this with Social K. Social K is an advisor that specializes in sustainable retirement plans for companies and organizations, and they're our advisor. They wrote the chapter for employers, and we wrote the chapter for employees. And so we go over 10 steps for employees. I won't go into the employers one, but we'll give you links to download it, and you can, and you're welcome to look into that. But I'm going to go over the 10 steps for employees to get more sustainable options added to your plan. So the first step is, if you're not already, or maybe even if you are some, to educate yourself about socially responsible investing. And we have a fact sheet in this guide that has 4 points about that. The first point is, it's not new. The idea about how we invest has ethical considerations. That really goes back to biblical times. It was part of indigenous cultures. The Methodists have been investing this way for centuries. That's been part of their investment philosophy. The Quakers started the first responsible fund back in 1928. But the modern era of responsible investing kind of took off with the social movements of the 60s. And then in the 90s, the idea of ESG, environmental, sustainable, and corporate governance came about. So it's very well established at this time. And then also, as Grant mentioned, there's this myth that socially responsible investing underperforms. It's very common even today, and that's simply not true. We actually list a bunch of studies on our website going back decades that show that responsible funds perform as well or better, especially in the long term. And that's what retirement investing is, it's long term. And this graph shows the performance of the first socially responsible index fund that was established by Amy Dominy in 1990. And so here's the graph, compares it to its corresponding index fund versus the socially responsible index that doesn't include things like fossil fuels. And literally over decades, the socially responsible fund is outperforming. So another thing to know is that socially responsible investing has options in all types of investings. If you stocks, bonds, mutual funds, ETFs, fossil-free funds, as you saw, list dozens of fossil-free mutual funds and ETFs in all sizes of, like mid cap, small cap, large cap, from really conservative investments to more aggressive growth. We have a list of community investment and impact investing funds on our website, and we have a green business network that has certified dozens of financial advisors, and this is what they specialize in, is in socially responsible investing. And then finally, it is growing. So as of 2024, according to the US Sustainable Investment Forum, over 6.5 trillion with a T is invested in funds marketed specifically as sustainability focused, ESG responsible funds. And the outlook is very good for more of that because basically young people really, really want it. So 97% of millennials and literally 99% of Gen Z said in a Morgan Stanley survey that they are interested in sustainable investing. So it's not going anywhere, and this is all the more reasons employers should have these funds and these fund options in their plans. So basically, once you've kind of got a handle on what is socially responsible investing and you've busted kind of the myths of it, steps 2 and 3 is basically to identify other coworkers in your company or in your organization who share these goals. And there's likely to be quite a few of them. If you're interested, as mentioned, basically any young person is interested in this because they want a stable climate when they're ready to retire. But get together and form a group and work together, educate each other, talk about why employers should offer this. If your employer has any sort of outlook for the future, for example, if it's a solar panel installer or producer, or really any kind of future orientation, more sustainable options would align with those values. It gives employees greater investment choice, it builds employee morale, and it provides a benefit of enduring financial value. So then the fourth piece is to evaluate what your own employer has. It's kind of amazing how many people have not logged into their retirement plans, have not looked at what their employer has, much less evaluated it. But this is basically what I did to evaluate my own employer options. So you want to know that each fund, and you may know this, has a name, it has a ticker, and there's a fund manager. So the name, might be Equity R6 or Total Stock Market Index. The manager in these two examples are Calvert and Vanguard. And then the ticker in these two cases are 5 letters. Sometimes I've seen 3, but often 5. So what I've done is search them on Morningstar and search them on fossil-free funds. So Morningstar this is your conventional investing hub. They have a lot of information, and you can look up a fund. It's helpful to have the ticker to look it up there. And so if you look up the Calvert fund, you'll see they give it a 2-star for performance, but a 5-star, 5 Earths for sustainability. They give the Vanguard fund 3-star for performance and only 3 for sustainability. But don't stop there. A lot of people would just stop at Morningstar, go to fossil-free funds and look it up there. And there you'll see that the Calvert fund is rated A, nothing in fossil fuels, while the Vanguard fund gets a D because it has almost 8% in fossil fuels. So this will really tell you, looking it up in more than one place will really give you a lot of information. So also understand that most retirement plans have what's called a default option. So if somebody is contributing, but they haven't gone in and picked, I want these funds, this amount of my contribution to go here and that amount to go there, it gets dumped in a default option. And most default options for a lot of employers are target date funds. So those funds are pegged to the year you're going to turn 65, that you're going to retire. And they're meant to be more aggressive and growth oriented when you're younger, so like a 2050 fund, whereas a 2030 fund for somebody that's going to retire soon is going to switch to safer investments like more bonds. And that's kind of how those target date funds work. The problem is most of them are not sustainable. And even the 3 here, this is from fossil free funds, they rate these target date funds. even these three marketed as sustainable are not particularly sustainable. They're probably better than the alternative for target date. But when I learned that, I like really evaluated every other fund in my plan and found other funds to move my investments into. So Carbon Collective offers fossil-free target date funds. That might require, it would be a bigger lift for an employer to switch entirely to a totally new fund manager versus adding funds to the plan they have, but that is an option as well. And then also we just want to say something about Vanguard, because Vanguard is a very common fund in a lot of retirement plans and has a lot of target date funds as well. So Vanguard made its name on index funds, which means that if it's an index, it grabs a little bit from each company in the index. And so any given index, say the S&P 500, and by doing that, you don't have to have a human person picking and choosing which funds go in. It's just a little bit of everything. So it's passively managed, which means it has really low fees. And because of that, it's become very popular. But when you select an entire index, that's necessarily going to include some fossil fuels. And because Vanguard has gotten so large, it is now the largest investor in fossil fuels in the world. It's the top investor in Exxon, it's second in Chevron. And we have several allied organizations, for example, Earthquaker Action Team, which is based largely in Philadelphia, where Vanguard's headquarters are. This was a protest they did right outside of Vanguard's headquarters that had hundreds of people. This is just a small part of the crowd that was there. So once you have a handle on what's in your retirement plan and you have a handle on socially responsible investing, the next step is to start meeting with your HR person. And this is for your whole group. It's best to have a group of people rather than trying to do this yourself to demonstrate that there is interest. So you want to share a packet of educational material about socially responsible investing. It's quite likely that they aren't aware of it or they think it underperforms. That's a common misconception. Identify their questions, identify their concerns, find answers. You might suggest a socially retirement plan advisor. And you may have a series of back and forth meetings with them if you get questions and you go find the answers and then you come back and you share what you've learned. But find out what their decision-making process is, who is involved. If necessary, bring in experts in socially responsible investing, possibly a financial advisor. I mentioned the ones in the Green Business Network or fund managers that manage socially responsible funds. But you want to get their questions answered. And this may take a few meetings of back and forth. That's why we have it steps 5 through 8. And then finally, if your employer is receptive, find out when socially responsible options could be added. There is a bit of a process for adding those and what that process is, how it would work and when it can happen. Keep checking in with HR, make sure that the other employees are informed. And if your employer is not receptive or still seems really hesitant, don't give up. Find out when is a good time to bring it up again. And in the meantime, start bringing in more employees. In Google, they had a group of 1,000 employees had signed a letter. So you could start a campaign like that. The employee voice is really the strongest voice. We did an action alert on the Google campaign where people sent Google a letter saying, Green American members sent Google a letter saying you should offer these plans, but really the employee voice is the strongest. And that's it from me. These slides will be sent out, I believe, to you all, and all these links are clickable, and you'll be able to download our guide and click all of these other links. So thank you.
Thanks, Kathy. I will take over the screen share. Can you see that okay, Kathy? Can I get a thumbs up before you disappear? Awesome, thank you. All right, well, thank you everyone for joining, and it's exciting to see how many people are interested in this topic. I'm Alex Wright Gladstein, and I'm the founder and CEO of Sphere, and my background is that I have been working to turn around um, let me make sure my screen is still showing. I think it is. For some reason, it's not showing as showing here. Let me check the chat.
Yeah, we can see it, Alex.
Perfect. Okay, good. All right. Okay, so my background is that I've been working to turn around climate change my whole career. Decided early on I wanted to be a serial entrepreneur. And so I helped spin a technology out of a lab where my co-founders had invented the first processor chip to communicate using light. And that company is called IR Labs. We spun it out in 2015, and we're cutting the energy use of AI in half by using light to move data between chips. And back in 2017, we started offering a retirement plan to our employees, kind of similar to Grant's story, where um, this really opened my eyes to this issue because I asked our providers if we could have a climate friendly option in the lineup, and it ended up taking over 3 years and a lot of persistence to get a single option that at a baseline wasn't invested in fossil fuels, which meant at a climate tech company, we were requiring all of our employees to invest in fossil fuels for over 3 years. It drove me crazy. And that's why I started diving in to try to understand the 401k industry and talking to as many people as I could in the 401k industry. And I kept hearing people say, well, in 401ks, you can't do climate friendly investing because you can't make decisions based on personal values or corporate values. It has to be based on financial measures. And I looked up the data and I found exactly what Grant presented and what Kathy presented again. It was some of these graphs showing the returns of different sectors of the economy. And it's really easy to see how fossil fuels have performed because what companies like Morningstar, or Bloomberg, or S&P Global categorize as energy is just fossil fuel companies. Solar and wind companies don't get categorized as energy, they get categorized as tech. And so we've just replaced the word energy in this graph with fossil fuels to make it clear. This is the energy sector returns in red here compared to tech or consumer discretionary, and all these other sectors that S&P Global tracks. That's the same company that makes the S&P 500 index. And over the past 10 years, those fossil fuel companies have had the worst returns of any sector. I'm just repeating what you've already heard, but it was a shock to me to see this back in it was like 2018, 2019, 2020 era where I was just like banging my head against a wall trying to get a climate friendly option on our 401k plan and continually being told we couldn't because we have to make decisions based on financial measures. And I was just like, well, look at this. The data is here. Why can't we do this? And then I started getting answers like, well, that's just one specific 10-year period. And so, like any company and any sector can have good or bad returns over one specific period. It's not really a trend if that's all you're seeing. So we looked up more data and we saw actually over the past 15 years, same holds true. Fossil fuels have had the worst returns of any sector. And actually over the past 20 years, the same is true. And so the only time periods where that isn't true is actually really short-term time periods. There's short-term time periods, like, for example, after when Putin invaded Ukraine in 2022 and oil prices skyrocketed. And then there were headlines everywhere about how oil and gas are on a tear and a great investment. It's questionable whether you want to be profiting on that type of investment at that moment, but at least in the financial news, you see a lot of those headlines in those kinds of times. Um, but seeing that on any longer time frame, they just consistently underperform was really surprising. And as I showed this to more and more people, I start getting more questions like, well, why isn't my financial advisor aware of this information? Why aren't more people who are financial professionals aware of this information? And I came across a graph like this one, first in S&P Global, and then I kind of replicated it across a few different time frames. And it shows the volatility of each sector. And this is, again, over multiple time frames that are all long-term time frames, 10, 15, and 20 years. The energy sector, those fossil fuels, have also been the most volatile. So aside from being the worst performing, they also have the highest volatility, which if you're talking to finance people, they kind of use the word volatility and risk interchangeably. So it's the most risky thing to invest in and also has bad returns. So this is what really drove me to realize, okay, this is wild that this data is here. Most people don't seem to be aware of it. And maybe we should do something about it, especially because I also started coming across the fact that some really big institutions were getting out of fossil fuels. The New York State Pension Fund, the New York City Pension Fund, and actually Amy and Cassie and the climate finance team of Stand.earth are some of the people who are behind some of the divestments of these entities. Um, and the state of Maine also got out of fossil fuels. I think the Church of England is out of fossil fuels. It's really all over the place, the Harvard Endowment. And I realized, okay, all these bigger institutions, wealthy people, the Rockefeller descendants, this is the family that made its wealth by creating the company Standard Oil, which got broken up into Exxon, Chevron, etc. These are the Rockefellers, and most of those descendants have gotten out of fossil fuels in their own investments. And I thought, okay, if wealthy people and institutions are able to get out of this badly performing sector, why can't everyone else? Why are we all required to invest in it in our 401ks? And I realized, it's probably not a problem of providers saying, no, we don't want to do this. It's not that like the Fidelities or the Vanguards or the um, Voyas or whoever your like retirement platform is, it's not so much that they want to keep it out, it's that there weren't climate friendly funds, i.e., funds that excluded fossil fuel companies that were checking the boxes of what fiduciaries needed to see, which is good performance and low fees. Because it turns out there are a lot of lawsuits in the world of 401ks, and they fall into two categories. There are excessive fee lawsuits and underperformance lawsuits. And while climate friendly funds have existed for a long time, we heard Kathy talking about some of them, they've been actively managed, which means you're paying somebody to pick stocks for you. It's an expensive way to manage a fund. So that means they are more expensive. And of course, employers are going to be wary of those excessive fee lawsuits if they have expensive, actively managed funds. And also, if it's actively managed, sometimes it outperforms the stock market at large, sometimes it underperforms. The only thing you know for sure with any actively managed fund is it's not going to track the stock market exactly because it's not an index fund. And so, of course, employers are going to feel a little more wary of adding these actively managed funds because that means that they have to more proactively track their performance and make sure they notice if they underperform and they have a good process in place to replace those underperforming funds with better performing funds. And a lot of employers are just wary of signing up for that extra work. And so I just asked, why aren't there any climate friendly funds that are designed to check the boxes of what they look for? Low fees, index funds. I couldn't find a good reason it didn't exist, and so we created one. It's called the Sphere 500 Climate Fund, and this is the first in a group of climate-friendly funds that we plan to launch. But this first one invests in the top 500 U.S. companies by market cap, and it excludes a few different types of companies. We exclude the fossil fuel companies and also lead contributors to deforestation, private prisons, tobacco companies, civilian firearms companies, and weapons manufacturers. And for the rest of the companies, the ones that we do invest in, which is over 400 out of the top 500 US companies by market cap, we vote our shares to get them to do better when it comes to climate change, planet, and people. A lot of people don't even realize when you're investing in a 401k or a retirement plan, you're investing in these funds, and those fund managers who manage that fund for you are voting on your behalf every time any of the companies in the fund has a shareholder proposal. And there are hundreds, even thousands of shareholder proposals to vote on every year if you're investing in these index funds that invest in hundreds of companies. And so you, of course, you can't be expected to keep track of every single shareholder proposal and figure out how to vote, right? So that's why these fund managers vote on your behalf. But because the world has been moving overwhelmingly towards index funds over the past few decades, and index funds just try to minimize costs, what they do is they just by default vote with management. So they vote however the management of the company recommends that they vote. And that has meant that they've voted against 98% of climate change related shareholder proposals. And it's classic short term thinking, right? Management is financially incentivized to maximize short term returns. That doesn't always align with what you would care about when you're saving for retirement, when you're making long term investments. And so we align that and we vote in favor of those things, which we think helps set up companies for financial success in the long term. So, I already talked about a lot of this, so I won't spend too much time on these other slides, but this just gives another kind of visual of how most of our exclusions are in the fossil fuel sector. We also have a few exclusions in these other sectors. And we're left with about 410 out of the top 500 that we invest in. And we partner with really a top-notch group of companies that help us make this product possible. And then on the voting, I can give a few examples of how this really makes an impact. So, for example, and I also love giving examples where doing better for the planet also means doing better for your financial bottom line if you're investing for the long term, which most people saving for retirement are. They're not day traders. Um, and so one example is Costco had a shareholder proposal where they were looking at putting solar on some of their facility roofs, and management recommended against it, right? It's an investment up front. We voted for it, and we partner with As You Sow with their recommendations through As You Vote so that we can offer this service without having to charge a lot. We can be an index fund, 7 basis points, priced much like any S&P 500 index fund. And we can do this thanks to As You Vote, making this available to us from As You Sow. And so we voted in favor of that. And it helps the financial bottom line as well if you're investing for the long term, because you get your payback in the next 2 or 3 years when you're investing in solar, and then you're just saving money on your power bills from then on out. So we're lowering the expenses for Costco by voting this way, and also doing better for the planet. Another example is the big banks. Three of the biggest banks in the US had shareholder proposals in the past few years to stop financing new fossil fuel development projects. Now, because our fund invests in those big banks, we were able to vote on those shareholder proposals to tell them, hey, stop investing in new fossil fuel development projects. Scientists are pretty unanimous in showing us that if we want to be successful turning around climate change, we have to stop developing new fossil fuel projects. And we also believe that it's good for the financial bottom line of these banks, right? They're assuming that demand for fossil fuels will continue to be strong 20, 30 years from now. The reality is, companies taking out these loans are likely going to default on these loans because demand for fossil fuels is reducing more quickly than anyone is forecasting. And so we're protecting the bottom line of these banks and also protecting the planet. And it's amazing how often and really how all the time doing better for the planet actually helps for the financial bottom line in the long term. So just to summarize, we launched this first fund, the Sphere 500 Climate Fund. It's not priced at a premium. It's priced to be similar to any S&P 500 type index fund. And it's truly fossil free. It's easy to add to existing 401k plans because we're not asking HR to switch 401k providers. You can send a quick email to HR saying, hey, can we please add this existing fund to our existing plan? And that can be actually a pretty quick and easy thing for someone in your HR to take care of. It doesn't have kind of the big headaches involved with switching 401k providers entirely. And we're available now on pretty much almost all of the 401k platforms out there. So I have here a list of a bunch of the names of platforms we're on. Even if you don't see the name of the 401k provider that you have up here, reach out to us or reach out to your HR or your 401k provider because we're getting added to new platforms all the time. And it's through getting requests from plan participants like yourselves that we do get added to more and more of these platforms. And then you can also invest directly. So if you have retirement savings from an old employer that you've rolled over into a traditional IRA, you can open an account with us directly, or you can invest through one of the brokerage platforms that we have listed here. And that is it on my end. Thank you so much. I'll give it back to Cassie.
Thanks so much, Alex, Kathy, and Grant. That was so amazing. Appreciate hearing from you all. And we so appreciate all the work you do in taking the time to join this webinar today and share these really important resources and information. So I'm going to wrap us up. And then, Amy, if you wouldn't mind just sharing the next steps slide from the slide deck, that would be great. We really appreciate you all taking the time to attend this webinar today. Retirement funds are a cornerstone of financial security, ensuring stability, and during life's later stages. So we should really all have the option to choose a climate safe retirement plan and not invest in climate chaos. We know that individual actions can drive systems change, and this starts with you. We really encourage you all to use the resources that were shared today to help you look into your retirement plan. Thanks so much, Amy. And see what other options are available and push for change if needed. If you need help requesting more information from your plan or requesting a climate safe investment option, we have templates for each type of request that you can use, and I know Sphere does too. So these links will be sent out in a follow-up email as well. And if you've moved your money or made a request to your plan for more information or to add a climate safe option, we encourage you to fill out the Climate Safe Retirement Fund reporting form that will be shared in the chat and in a follow-up email so we can track and celebrate your wins and support you if you need it. So I will put that in the chat right now. And of course, if you find yourself wanting to reach out to others at your workplace and organize with them for climate safe options or join the grassroots movement advocating for climate safe pensions and retirement funds, Stand.earth is here to help. Please reach out to me or Amy and we can help you advocate for change. My email is cassie.kane@stand.earth, and I'll also put that in the chat soon. And lastly, if you would like a resource to share with your employer, or if you are an HR or operations professional who would like more information, Climate Safe Retirement Funds is presenting another webinar in the future on how HR leaders can offer climate safe retirement options. It will be a practical, solutions-oriented webinar designed specifically for those who want to align their organization's retirement offerings with their climate values and fiduciary responsibilities. I'm really excited for this one, so please stay tuned for the date and registration details by following Climate Safe Retirement Funds on Blue Sky and LinkedIn. And then we also have a webpage that I believe was shared in the chat. So with that, I'll wrap up. Thank you again to our panelists. Thank you all for joining this webinar. Please stay tuned for the follow-up email for all the links shared today and how to stay in touch with this campaign, Green America, As You Sow, and Sphere. Thank you again and have a great rest of your day. Thanks, everyone. Bye.